Hey everyone, me Kevin here. In this video, I'm going to tell you what to pay attention to regarding the Federal Reserve this week. Then I'm going to give some suggestions on stock trading and swing trading. Let's get started. Right after, of course, I mentioned that Robinhood reached out and was super happy that thousands of you signed up for your 4 free stocks with Robinhood. Yeah, they're taking a pitch out of the Webull there. So if you haven't yet, use the Robinhood link down below. Sign up. You don't even have to deposit any money with them. You link your bank account with Robinhood. Very important you link your bank account, and without depositing any money, you will get 1 free stock within a day and 3 free stocks on February 1st as long as you've linked your bank account. Go to metkevin.com/Robinhood or use the link down below. All right, let's get started. On the Fed, on January 26th to 27th, the Federal Reserve is meeting again, which means the Federal Reserve will have a press conference featuring Jerome Powell, good old J. Powell, likely around 2 p.m. on the 27th, which is just 2 hours about before Tesla releases earnings for quarter 4 2020, which is widely anticipated to set a lot of expectations for the EV market. But for right now, let's focus on the Federal Reserve. What should we pay attention to right now? First, let's get out of the way what we should not focus on. Interest rates. Interest rates at 0 are here to stay for the time being. So when you hear headlines on the 27th about, oh yay, the Fed decides to keep interest rates at 0, you could say, wow, news for the masses, not news for me, because we already know they have no intentions of raising rates for the very long foreseeable future. And I guess by very long, I mean like 2023, 2024-ish. Instead, there's something more important that happens before the Fed does rate changes. We saw it happen in 2013, then we started seeing that go into effect in 2015, 16, 17, and even more so in 2018. That is what we want to pay attention to, the signal, the 2013 signal. When is that going to come again? And that's what we're talking about in this video. So, the signal comes in what the Fed, aka Jerome Powell, says about their quantitative easing, also known as their monthly bond purchases. Every single month, the Federal Reserve goes into the marketplace and buys about $80 billion of bonds, treasury bonds, and $40 billion worth of bonds for mortgage-backed securities. And this helps inject money into the economy. It's a form of monetary stimulus. There's fiscal stimulus, which is like Congress sending stimulus checks eventually. They're really slow at doing that. And then there's J. Powell, who does monetary stimulus with the money printer every single month. So the Federal Reserve's quantitative easing is a big deal. And right now, the market is already expecting that the 27th could potentially just be another non-event. However, where the real interests lay right now and what people, like Wall Street people who sit on their Bloomberg terminals and go, Bloomberg terminal came out with an update 27 seconds ago. I will buy everything related to that industry, and then I will watch Wall Street Bets in 2 hours react to it. But although lately that hasn't really been true with GameStop. GameStop has been pissing off a lot of Wall Streeters, which they deserve it. I love that. But the point is, this is what the people on Wall Street are going to be looking at. Because you've got already people like Cathie Wood over at ARK Invest who are saying, pay attention, there's a good chance the Federal Reserve is going to end up changing their position towards the end of this year, and they're going to stop buying as many bonds as they usually do, the 80-40 that they do now, the $120 billion in bonds, and they're going to do that because they're going to realize that inflation is starting to pick up, and by changing their wording now, as sort of step one, they change their wording now on bond purchases, then they stop or reduce bond purchases, and then they increase interest rates. So in other words, the market's looking at that initial signal of them saying, yeah, you know, if the economy does really well, sure, yeah, we'll reduce bond purchases. That's going to have some funny implications. And see, if Cathie Wood is right, we should all be preparing ourselves. We should have cash on the side to be able to buy the dip when and if the market drops, which she expects that there's going to be a sizable drop at some point this year if she's right. She thinks inflation is going to come in a lot stronger than the market, or I should say, than maybe the Federal Reserve thinks it's going to come in. And because of that, Cathie thinks there's a good chance we might end up getting a little bit of a surprise, which is one of the reasons she sees Bitcoin as an exceptional hedge against inflation. Now, to counter the fears of Cathie and others, investors believe that the Fed's basically going to have to double down and make it really, really clear No, we will not stop buying bonds this year. That's what we want to hear. So we're not expecting them to talk about stopping bonds right now. What you want to, like, if you were going to write down something, write down right now, what is the Fed saying about the second half of 2021 regarding bond purchases? Okay, that sentence right there, really, really important. We want to know what the Fed is thinking now about the end of 2021, because that's going to signal to us, okay, if they're going to reduce bond purchases at the end of 21, then they're likely to start raising interest rates in 2022 rather than in 2023. And that's going to have some implications for the market. One of the reasons the market is so, dare I say, frothy right now, I think I do say that, why the market is so frothy right now is because people have so much freaking money because interest rates are so low. Housing prices go right through the roof. You call up your banker, you go, yo, I want to refinance my house. And 6 months later, because refinances suck right now, you get some money. And what do you do with that money? Tesla call options or GameStop. All right, so right now you should have that written down and you should have marked your calendar for the 27th. I'm pretty sure I'll be live streaming Jerome Powell's talk, so you can come to the channel. You might not get a notification for it, so be here. All right, now, why do we think, or why do some people on Wall Street have concerns? I want to hit this and then what we should do about it. Well, first, keep this in mind. One of the reasons people are fearful is because Harper, Kaplan, Bostic, and Evans, all regional bank presidents, have all indicated basically that we should consider beginning to taper at the end of 2021 if the economy is doing really well. Now, they're not as strong as Mr. J. Powell. He's really strong, and that's what matters. And again, this is why the 27th is, it's always going to be an important date when the Fed talks. And I'm really giving you a preview here of what to pay attention to. Now, this does happen a day before my birthday, which means you should definitely take advantage of using the coupon code down below to join the programs on building your wealth and join me in the private live streams where every day the market is open. I share my thoughts on not just the market, but stocks, analyze your real estate deals, and answer your questions about making YouTube videos or property management, because those are all the courses I've linked down below. All right, now, so we understand where the fears are coming from. We understand what to look forward to. But before we talk about what to do, we should talk a little bit about what happened last time, just so you could see how much time you had last time and maybe how much time you'll have this time. In 2013, we saw something called the Fed taper tantrum. This is basically when Ben Bernanke, the then Federal Reserve Chairman, came out and suggested, hey, it wouldn't be a bad idea if we start reducing our bond purchases. Basically, the market freaked out, bond prices collapsed after this, but the stock market actually held up in the short term, actually I should even say the medium term, because the taper didn't actually start happening until 2015, 16, 17, and 18, which is where we saw the taper and then interest rates start going up. 2018, when the Fed under Jerome Powell aggressively raised rates too much too quickly, we saw the stock market pull back in one of the worst sell-offs that we had since the Great Recession. And we kind of, as much as possible, want to have an educated guess on when that potential next sell-off could happen again. So that way, when it happens, we know why it's happening, and we could look to history to try to understand what might happen next. But who knows, maybe we can actually be properly prepared for it by going into a recession with as little debt as possible. One of the beautiful things that helped me build my wealth, like insanely in 2020, was having a lot of debt available. That's different from having a lot of debt. See, I actually had very, very, very little debt going into this pandemic. And that allowed me, as soon as the crash happened, to, as I always say, break the piggy bank, take money out with refinancing properties or drawing on credit lines to go shopping in the stock market. But anyway, this means that if you respect the Fed, like if you don't care about the Fed, you're probably not watching this video, so I'm assuming you care about the Fed or you respect the Fed. But anyway, in my opinion, the Fed's meetings are your opportunity to assess how prepared do I need to be for a potential Fed-induced crash coming. This isn't saying that there won't be another crazy crash coming from something else. People's emotions are a freaking roller coaster, so you never know. But it's good to be prepared. Okay, now, what should we do in terms of short-term trades? If you are a swing trader, a day trader, you're looking for an opportunity to buy into the market, this is my take. My take is that the Federal Reserve Chairman Jerome Powell 9 days ago said, quote, "Now is not the time to be talking about exit. The economy is far from our goals. And as I mentioned a couple times, we're strongly committed to our framework and using monetary policy tools until the job is well and truly done. Folks, that's pretty blunt. Basically, if you're a trader, or even just a long-run investor, we've heard Jerome Powell 9 days ago say he's probably going to come out and give us really solid assurance that for the rest of the year, there's not going to be a taper. He's not going to reduce bond purchases. If he changes his mind because of his talks at his meeting on the 26th and the 27th, yeah, then we're going to have a problem. But if we were betting folks, it seems like the odds are, and this, who knows, might already be priced into the market, but it seems like we're very likely to hear Jerome Powell coddle the markets and make us all feel really good, and that Papa J. Powell ain't going anywhere, that the money printer is greased, and he's here for us brothers and sisters. So, in terms of trades, Jerome's talk about stimulus since the beginning of the pandemic and, along with Congress's stimulus, have really just helped this market continue on an arrow going straight up and to the right, aka a rocket ship to the moon. So while I think that earnings at companies could miss some already high expectations, consider this. If earnings do smash expectations, it's entirely possible that after the Fed talks and companies smash earnings, it is entirely possible that these companies start getting substantially overcompensated and we see the highest stock market we have ever seen before. Entirely possible. Because when we merge these things together, people just got coddled about, the Fed not tapering. If people literally just got coddled at the beginning of earnings season, and then at the same time, companies smash already high earnings, folks, I don't know if you want to call it a bubble or what you want to call it, but we're gonna see some rocket ships, okay? This means that electric vehicle companies, green energy, things that already have the winds at their back, yeah, looking good. Tesla, Enphase, Lucid, if the CCIV partnership happens, looking good. Blink Charging, SBE, the big daddies to CLII, which is the new SPAC that was announced Thursday night, which will merge with EVgo, a relatively small electric vehicle charging company with under 2,000 chargers in total that is now worth a ridiculous amount, many billions of dollars. But wow, SPACs. Gotta be careful with some of SPACs. But anyway, dude, EVgo, I don't even realize this company is so small. But anyway, people hear SPAC and anything related to EVs, moon. Anyway, what this means is we're going to see some high prices, very likely, if these companies smash earnings and Jerome Powell doesn't disappoint us. And honestly, both of these things are entirely possible. It also means that tech could continue to rock on, because as interest rates are low, people decide where is a relatively safe place that I can invest my money. And no, that's not the entire tech industry, but it's certainly, in my opinion, companies like Apple, Microsoft, even Amazon. These are relatively low vol companies. And sure, you could look back at the pandemic and say everything had volatility, but there was no safe haven then, right? And Apple and Microsoft report this week, and then after that, we're going to have earnings, obviously, from the Amazons, the Wayfairs, the Etsy's, and Redfins, and some of our other favorites. As a result, if we were going to trade options, look, I'd be selling puts low and I'd be buying calls a bit high. That way, if you're forced to execute on a put, you're getting your favorite stocks lower. If your stock skyrockets, you get to play with the gains as well. Personally, I'm going to probably, I'm on a stock diet. I really should not be buying any more stocks. So I'm torn. I don't know what to do. But again, if I were a betting man, I would be putting money on black. Okay? Things are going. It's ridiculous. It's ridiculous. Anyway, hopefully this provides you some insight into what to expect, not just this week, but also, remember this, very important takeaway, okay? You already wrote some things down on your calendar, but remember this, very, very important. Get your 4 free stocks with Robinhood. Okay, sorry, I had to do that. And get your courses down below. Sorry, I had to do that as well. No. What's very important is, look at what we have aligned here. The Fed coddling markets, and then earnings season on some big names very shortly thereafter. Not like the Fed talks, frequently throughout the year. I'm pretty sure they have 8 policy meetings, but so this happens. But this is also the start of 2021. Some Fed coddling, beginning of the market or beginning of the year? Yeah, I don't know. We'll see. Let me know what you think in the comments down below. Thank you so much for being here, and folks, we'll see you in the next video.